There seemed to have been a building consensus, certainly over the course of the last, call it month, 2 months, at least since the last Fed meeting in September at least, that a lot of this was priced in. I think the market had pre-positioned for a Fed rate hike of 25 basis points, and arguably that's what you've seen playing out. Now, yesterday, I think the market's fixation shifted from the initial move of the 25 basis point hike towards the guidance that was issued by Fed Chair Janet Yellen in terms of how the profile of this hiking cycle would play out. And on that count, Janet Yellen sounding remarkably dovish, guiding that we need not see a hike at every successive meeting, that the spacing between hikes could actually vary, that the size of hikes could vary as well. And all of this talking to the context of the fact that the Fed is quite jealously guarding this U.S. economic recovery that has taken quite some time to build. And not only that, the fact that inflationary risks, whilst they are deemed, or the decline in inflation was deemed to be transitory, that they would wait to see some clear signs of inflation potentially before executing the next move upward.
That is good for emerging markets, this slower increase, ongoing increase in hikes, in interest rates. But Mohammed, have we seen the market reaction? Could the rand weaken or strengthen in coming days, or have we seen this? Can we say this is how markets react?
So I think even prior to our own domestic developments, which we've had over the last 2 weeks, we were arguing that the reaction to the Fed would be very much one of buy the rumor, sell the fact. And that's what we're seeing playing out. So today, in fact, we've seen the rand trading on the front foot. We've seen it strengthen very temporarily below that 15 rand mark. There is a technical level between 14 rand 80 and 14 rand 90 that is currently proving to be a little bit of resistance for the rand. We need to break below those levels if we have a hope of trying to look at the 14 rand 50 mark. But unfortunately, this is significantly higher. I mean, if we had a look at where we were trading prior to the domestic developments, well, we were expecting a pullback into the upper 13s, maybe the mid 13s. So one could still argue that there's an additional 1 rand to 1 rand 30 premium that is being placed on the rand relative to some of our other EM peers, and that's specifically a South Africa risk premium that's now trading on top of the rand on the dollar rand cross.
So you're saying that local factors are important. We saw that market turmoil, the change in the finance ministers, Moody's and Fitch talking about it. Is that the more pressing issue now, the possibility of South Africa even being downgraded?
So I would actually categorize those in two separate buckets, both having an impact on the outlook for the rand. I think if we look at the domestic context, we remain quite bearish. We saw Moody's changing their outlook yesterday whilst we were closed, and this telling me that the prospect for another ratings downgrade from either S&P or Fitch during the course of 2016 remains remarkably high. That in the context of a dollar that we would expect to remain structurally strong, the possibility of yet another Fed hike coming through during the course of 2016, those factors collectively would leave me negative on the rand against all of the crosses, but more specifically against the US dollar.
Okay, so what do we have to do? This uncertainty around the Fed has been removed, but you're saying that the risk of local factors still affecting our currency there. What do we have to do as an economy to avoid any downgrades next year?
Well, Francis, the term structural reform has been bandied about quite a bit, but I quite often think a lot of people don't actually understand that. First and foremost, we need to not tinker with the institutional factors that are quite well respected by the private sector, by the international markets. And those factors would be the National Treasury, the Reserve Bank, a sound judiciary. But over and above that, when we have players coming out saying that there's no policy shift, that's well and good in that the concern was initially for a drift in policy towards more populist-oriented policies, but that's not enough. We actually need to start seeing more market, more business-friendly policy clarity coming onto the table. And then South Africa's fantastic at formulating policy. The NDP, for example, is a fantastic blueprint to that effect, but we need to actually start delivering the goods. This really falls flat on implementation, and unfortunately, where historically South Africa was given the benefit of the doubt amongst our EM peers, recent developments have meant that international investors are probably a little less charitable, and so unfortunately we may not be given the benefit of the doubt going forward.
All right, coming back to the rate hike in the US, what does it mean for ordinary people, non-investors in South Africa? I guess if you've got debt, the talk was that our Reserve Bank would feel compelled to raise interest rates as well. Are we going to see another rate hike?
I certainly think so. I think, related to the fact that we've seen this hike from the US Federal Reserve, that would have narrowed the yield differential between South African yields and international yields, and that arguably would result in capital outflow. Now, the way the logic flows is if the capital flows out of South Africa, the rand would weaken. If the rand weakens, that would come through with an inflationary impact to the end consumer, to the man in the street. Now, unfortunately, for a confluence of events, we have actually seen that rand weakening, and so on the back of that weaker rand, we know that the SAB is very concerned around second round impacts to inflation from a weaker rand, and on that basis I think there's a firm case now for them to continue with their hiking cycle at the January meeting. There's a meeting at the end of January. The SAB has come out with very clear communication saying there will be no emergency meeting, but that meeting at the end of January still leaves the scope for them to either hike rates by 25, maybe even 50 basis points at the stage, really much depending on how adverse the capital flows do result, and not just now into the tail end of the year. Liquidity is quite poor already, but certainly as the year starts in 2016 in January, they'd be assessing that and bringing that into their deliberations.
Mohammed Nalla at the JSE earlier. Well, that Reserve Bank of our own will be looking at what's happening globally when it makes its interest rate hike pronouncement in January. It will also look at inflation. The good news is that producer prices